Okay, let's dive right into this. Welcome to this explainer. Today, we are tackling what is, without a doubt, the single most misunderstood area of personal finance, capital gains tax. Because, look, we all want to make money, right? But actually keeping it, well, that's a whole different ballgame. By the time we wrap up today, you're going to have a clear-cut, absolutely foolproof guide on how to protect your hard-earned investment profits. So, picture this for a second. You bought some shares a couple of years ago. You kept a close eye on the market. The price went up, and you finally pulled the trigger and sold them. The money hits your bank account, and you feel amazing. You are officially a financial genius. But then, a few months roll by. You're sitting down to file your tax return, and you notice this little field labeled capital gains. And right next to it, a calculation showing that you owe the government a massive chunk of that profit. Bam! Talk about a nasty surprise, right?
But don't worry, we're going to fix that today. Here is our roadmap. We'll start with the capital gains surprise, move on to the basic tax formula, uncover the holding period secret, run through some real-world tax math, and finally, look at legal ways to save.
Starting with Part 1, the capital gains surprise, uncovering the hidden tax on your investments. You know, capital gains tax catches so many investors off guard simply because, well, no one really explains the rules up front before you click sell. To make sense of it all, let's ground the theory. A capital gain is literally just the profit you make when you sell a capital asset for more than you paid for it. Now, what's a capital asset? It's exactly what it sounds like. Any asset that holds value and can be sold. We're talking stocks, mutual funds, physical property, gold, bonds, the whole shebang. Basically, if you bought something, held on to it for a bit, and sold it at a higher price, that difference is your capital gain. And yes, unfortunately, the government considers that gain to be taxable income.
Moving right along to Section 2, the basic tax formula and how to calculate your actual gain.
Let's look at the fundamental math that governs this entire concept. And I promise, it's way simpler than it sounds. The formula is incredibly straightforward. Sale price minus cost of purchase equals your capital gain. Now here is the absolute critical part that trips people up. Tax is applied only to the profit, not the total sale amount. Let's say you bought shares for 1 lakh rupees and sold them for 1.6 lakhs. Your capital gain is exactly 60,000 rupees. The tax man only cares about that 60,000 rupees. You are definitely not getting taxed on the full 1.6 lakh sale amount.
Now for Section 3, the holding period secret, the timeline that dictates your tax bill.
So, the crucial point here, the thing you really need to remember is exactly how long you hold on to an asset before selling it. It's the most important concept in this whole space, and it changes absolutely everything. The tax code basically sorts your gains into 2 different buckets based entirely on time. On the left, we have short-term capital gains, or STCG. This happens when you sell too soon, and let me tell you, it triggers a much higher tax rate. On the right, we've got long-term capital gains, or LTCG. This is the sweet spot where your patience is rewarded with a lower tax rate. The tax system is literally designed to reward you for waiting. Honestly, holding an investment just 1 single day longer can shift you from that expensive left bucket to the cheaper right bucket, saving you a massive amount of money.
Now, what's really interesting is how these rules map out across different types of assets, especially after the Union Budget 2024 revisions. For equity, like your listed stocks, the magic threshold is 1 year. If you sell within a year, you get hit with a 20% short-term tax. But if you hold it for over a year, it drops to 12.5%. And here's the real kicker. That 12.5% is only applied on gains above 1.25 lakh rupees. For things like property, debt funds, and gold, the threshold is 2 years. If you sell those early, you get lumped into your normal income slab rate, which, let's be real, could be a brutal 30%. But if you just hold them past that 2-year mark, you rescue yourself and unlock a flat 12.5% long-term rate.
Okay, we also need to talk about indexation. Think of this as inflation's little gift to long-term investors. It uses a government metric called the Cost Inflation Index to legally adjust your original purchase price upward. It's basically a way of acknowledging that, hey, money 10 years ago was worth a lot more than money today. By artificially inflating your original purchase cost on paper, it actually shrinks your taxable profit. It's brilliant. However, and this is a major caveat, Budget 2024 actually removed indexation for newly purchased properties, trading it in for that flat 12.5% rate we were just talking about. All right, let's step into Section 4, Real-World Tax Math, seeing the theory in action.
We're going to run through some quick math to prove exactly how literal days can cost you thousands of rupees. Check out Priya's situation. She bought listed shares and sold them after just 9 months. Her profit, her capital gain, was 80,000 rupees. But because she sold before that 1-year mark, she fell straight into the short-term capital gains trap.
At a 20% tax rate, Priya now owes 16,000 rupees in tax. She essentially paid a steep penalty just for being impatient.
But now look at this alternative scenario. What if Priya had just held on and sold those exact same shares after 13 months instead? Well, her gain grew to 110,000 rupees. And this brilliantly illustrates the magic of the holding period. Because her profit was under the annual 1.25 lakh rupee exemption for long-term equity, her tax bill is exactly zero. That's right. By waiting just 4 extra months, she secured a bigger profit and completely wiped out her 16,000 rupee tax bill. No way, right? But it's true.
But what happens when the numbers get much, much larger? Let's say Raj bought a flat in 2018 and sold it 6 years later. After calculating his flat 12.5% long-term tax on a massive 37 lakh rupee gain, Raj is staring down a tax bill of 462,500 rupees. Yikes! That is a seriously painful check to write. Which brings us to the ultimate question. How can Raj legally avoid paying nearly 500,000 rupees to the government?
Let's move to and see how this builds into our final segment, Section 5, Legal Ways to Save, your toolkit for tax reduction.
Look, we really need to start treating the tax code not as a set of penalties, but as a series of incentives meant to guide your financial behavior. Here are 5 perfectly legitimate, totally legal strategies built right into the code. First up, the easiest one. Simply hold for the long-term threshold. Just wait out that 1-year or 2-year clock. Second, harvest that 1.25 lakh equity exemption annually by booking profits tax-free each year to reset your base. Third, if you've got losing investments, sell them. You can set off those capital losses against your gains. Fourth, and by the way, this is exactly how Raj saves his money. Section 54. If Raj reinvests his real estate profits into buying a new residential home within a specified time, that terrifying 4.62 lakh tax bill becomes completely exempt. Zero. Finally, number 5. If you don't want a new house, Section 54EC lets you invest your property gains into specified government bonds, like NHAI, to totally wipe out the tax.
So, as we wrap up this explainer, I want to leave you with one absolute critical thought to chew on. Next time you go to click sell, ask yourself, are you strategically timing your sales? Or are you simply paying a premium for impatience? Truly understanding capital gains means realizing that timing isn't just about catching a market high. Timing is literally the ultimate financial strategy to keep the money you've worked so hard to earn. Plan before you sell and make the tax code work for you.